In this video, we lay out an easy guide to understand the basics of options trading for a beginner. Options are one of the most complex financial instruments to speculate with. Whilst financial markets themselves can be risky, options are many times riskier, and therefore require expert knowledge to trade and master. Let's quickly address the most basic part first. What are options? Though it trades as a standard instrument, an option is basically a contract between two investors that helps them speculate on the price of an asset. This speculation can happen without actually owning the asset. Let's understand this with an example. Let's assume a trader has a view on Tesla's stock price 3 months down the line. We can call this trader a Tesla bull. Tesla bull thinks that the market is mispricing the stock and that the actual value of the company is higher. And
This is great timing. This is great timing because I see so many people saying that Tesla is such a buy right now, even though it's in its stage 4 downtrend, even though the sell signal came on December 20th. And it's got overhead resistance up here, and it's got a ton of people who are like, you know what, as soon as Tesla gets back up to whatever their entry price was, I'm going to get out. So for me, Tesla is the very, very bearish scenario. However, a lot of people are saying it's a bullish scenario. So let's play this out. I'm excited about this.
This should be reflected in the stock price in 3 months. Mr. Bull wants to speculate based on his view, but does not want to buy Tesla shares. He comes across another trader who has an opposite view on the company's stock price. We can call this trader the Tesla bear. Tesla bull and Tesla bear enter into an agreement that lists their views, thereby providing Tesla bull the right to buy the shares from Tesla bear at a predetermined price. This is called the exercise price. So, for example, if the price agreed between both parties is $165, Mr. Bull has an option to buy the stock at $165 after 3 months. Now, if the stock price at the end of 3 months is $190, the bullish trader stands to gain $25 from the agreement, as he can now buy the shares at a lower price from the bearish trader. The bullish trader exercises the option and can sell the shares immediately at $190, carving.
Right. I've never in my life once exercised options, not ever. I don't know anybody who actually exercises options, but that is the theory behind it, right? You can buy it for basically a discount if you want to think of it that way.
Out a nice profit. On the other hand, if the stock price after 3 months is lower than the agreed $165, the bullish trader can choose not to buy shares at $165 because those shares are available at a better price. But is this a bad deal for the bearish trader? He loses when the price goes up and doesn't gain when the price moves down. Well, not really. Enter options premium, which is an element in the agreement that will safeguard the interest of the Tesla bear. There would be a premium amount agreed upon at the time of the contract, and it will be paid by the Tesla bull to the Tesla bear for bearing the risk. The premium is non-adjustable and non-returnable, which means the bear keeps it irrespective of the outcome. So if the premium amount is $10, the Tesla bull gains only $15 from the contract if the price closes at $190 after 3 months. Tesla bear's loss is also $15, as the $25 loss at the time of exercising the contract gets covered by the $10 premium he received while entering the contract.
Oh, this is a really, really good explanation. I'm glad he's going into this detail.
On the other hand, if price closes below $165, the Tesla bull loses the $10 premium, and the Tesla bear gains the same amount as he gets to keep the premium. In this example, the Tesla bull will be termed as an option buyer, and the Tesla bear will be termed as an option seller. An option buyer has the right, but not an obligation to honor the contract, and an option seller has an obligation to comply if the option buyer chooses to exercise his right. In the example, because the option buyer was bullish on the Tesla stock, the option he will use is a call option. A call option gives the buyer the right to buy securities at a predetermined price. A bullish investor here buys the call option, while the bearish investor sells the call option. On the other hand, if the option buyer is bearish, he can use the other category of options called put options to speculate. A put option gives the option buyer the right to sell the security at a predetermined price. So, for example, if the exercise price is $165 and the stock closes at $140 after 3 months, the put option buyer can still sell the stock at $165 to the option seller and pocket the cash. If, however, the stock closes above $165, the option seller gets to keep the premium. But how is a premium calculated? The premium of options is derived from 3 main factors. 1, the intrinsic value or the moneyness of the option, which
Ooh, this is good. Man, okay, good explanation. I just want to give a quick story. So my gateway drug into trading options was on puts. I was in the office one day, and I overheard a couple of people having a conversation about Deutsche Bank. And one of them said to the other, he said, well, if you feel so strongly that Deutsche Bank is going to go down, why don't you go buy some puts on it? And I remember sitting there thinking, puts. I remember something about puts. And then I was one of those nerds in college who kept all of his textbooks. So I had all my textbooks on my desk. I worked in finance. And I had my bachelor's and my MBA in finance. And so I was working in finance, and I remember them saying, talking about puts. And I was like, man, I haven't heard the word puts in ages. So I went over to my textbook shelf, pulled out the old textbook, and there were two tabs in that textbook, right? Two like tabs on the side. And one of them was for bonds, because bonds are weird with the price of it going down while the interest rate goes up, all that stuff. But the other tab was for options. So I flipped to the options tab, and it's like a 900-page book. And I flipped to the options tab, and it talked about puts. Puts go up in value as the price of the stock goes down. Simple explanation. And that's all I needed to know. Wait a minute. You're telling me that I can buy something that will increase in value as the price of the stock goes down? I was like, let's do this. So then I remember popping up my very first option chain, which now I look back and I laugh because, like, in fact, I have an options chain pulled up right here. I remember looking at an options chain for the very first time and be like, whoa, what do all these numbers mean? I don't have any idea what these numbers mean. I just want to make money. And you probably felt like that too the first time you looked at an options chain. So I'll do my very best to make trading the easiest possible way that I can. I'll help you save time, make money, and start winning with less risk. But there's a lot to learn with options, and I geeked out real hard. I don't know anybody who knows more about options than I do, because when I do something, I jump in with both feet. So I'm excited to hear the rest of this video here. But he's going to talk about intrinsic value and extrinsic value. And that is actually a core tenet inside of how I trade. And we'll talk about this more in just a little bit. Hopefully I won't be too long-winded today. But when I look to trade, I buy deep in the money calls. I don't know if he's going to go into this detail, so I'm going to give a little backstory real quick. I go for deep in the money calls or deep in the money puts, and I look for 20% or less extrinsic value. Extrinsic value goes to zero on every stock, on every option, on every expiration, every time. So that is basically the decaying part of the option. I want to pay as little of that as possible. So 20% is really my criteria. I might go a little higher, I might go a little lower, but 20% is where I look to break even on that. So curious to see what he says here, but super stoked to hear what he says.
Tells how much in the money the option is. 2. Time value of option. The further out the expiration date of the option, the higher its time value is. And 3. Implied.
And time value. There's other things baked into it, but the time value right there is the extrinsic value mostly that we're talking about. That's what we're trying to pay as little as we can for.
Volatility of the option. The more volatile the option, the higher its premium. An option buyer has an unlimited upside and a defined downside, because the most one can lose is the premium paid. On the other hand, the option seller has an unlimited downside and an upside limited to the premium received.
Which is why, if anybody tells you, and I have seen more and more people start popping up in my feed talking about how the easiest trade to make is selling puts. If anybody tells you the easiest trades to make in the market are selling options, you tell them, number 1, stop. Number 2, tune in to Chris's channel. And number 3, you run away from them as fast as you can, because they're about to get monkey hammered. Like, doesn't matter what stock, they're going to get monkey hammered at some point. Selling options is the equivalent to picking up nickels in front of a steamroller. I got suckered into that. I traded that way for probably 4 to 5 years, just like thinking I was an absolute genius selling options, but I couldn't make money. I had an 83% win rate and lost constantly. Lost money on 83% win rates. I couldn't make it work, because every one trade that I would win, or every one trade I would lose, would take me like 8 to 10 trades to make back. So you have to be flawless in your execution. If one trade will take 10 trades to make back. Whoa.
Beyond the basic explanation of options, there are several complexities that get added to this arrangement in the financial world, but that will end up confusing you as a beginner. Therefore, it's best to understand options in its most basic form and build your understanding gradually. In a decentralized and non-digitized financial world, entering into such contracts could be a nightmare for investors. You have to find the counterparty, decide on the terms of the contract, and take the risk of the counterparty defaulting. But thanks to technology, all of this happens with the click of a button on most brokerages. All you have to do is pick the asset you want to speculate on, pick the exercise price or strike price, and pay or receive the premium quoted on the exchange. Next comes the real art: how to profitably trade options. Trading any instrument requires a mechanism to foresee the movement in the price. This mechanism can be based on quantitative factors like charts and data, or on qualitative factors like sentiments. For example, if your philosophy is breakout trading in stocks, you will become alert when the stock you are eyeing to trade is breaking out on the chart. Once the breakout happens, you can buy call options and wait for the breakout to either work or fail. The important part here is that you need to monitor the price of the underlying stock and trade the options when certain trading conditions are met.
And that's how I trade, right? I want to make sure that the price is moving in my direction, and when it stops moving in my direction, that's when I want to get out, right? And I don't base it on the price of the option. Like some people will put in orders to close if your option goes down like 30% or whatever. And the reason I don't put in orders in the market at all, ever, is because, and you can witness this. In fact, we might be able to witness it right now. This spread between bid and ask can widen like huge, right? So this one here is only 25 cents. This one here is about 10 cents. But there are times of the day when volatility picks up, nothing's really happening, but like things are starting to move around a lot more. So the bid and ask widens, and then you can get your stop loss tagged without even realizing anything was happening, without even the market showing you something's happening, just because the bid ask widened. And that freaking sucks. So never, ever, ever would I put a stop loss in on the price of the option.
While trading the underlying stock is straightforward, trading options is much more complex and riskier. You can multiply your capital, but you can also lose all the premium you paid. It's worth noting that premiums can fluctuate considerably during the day based on the price of the underlying security.
That's what I just said. I appreciate that.
So, if the premium you paid at the time of buying the contract was $10, when the price of underlying was $100, the premium could be quoted at $25 if the price moves by 20% to $120. That's a 150% return on the premium paid versus a 20% return on the underlying asset. On the other hand, if the underlying price goes down,
this is why I trade options. And I trade them specifically with deep in the money calls. And we'll explain a little bit more in a little bit. I'm going to really try and not be super long-winded today. But Larry Hite, the very first billion-dollar hedge fund manager, he's the one, market wizard Larry Hite, he's the one who taught me this strategy. Okay. Basically, you can buy shares for 10 cents on the dollar. I know that sounds impossible. You get a 90% discount by doing this, but I will show you mathematically how this works.
By 20%, the premium can see a 90% decline. This is the impact of leverage. The bottom line is that a small movement in the underlying price can lead to a large movement in the option premium. This movement largely depends on three factors that we touched on earlier. This magnifying or leveraging can help options traders to be profitable with a small amount of equity, provided they have a system of positive expectancy. Therefore, having a system is the most important aspect of trading options. You can't randomly buy and sell options and expect to be profitable.
Oh man, and like I said, back when I thought I was a genius, I remember specifically getting into an Uber. I was on a business trip. I got into the back of an Uber. I had my iPad, and if you know my story, like 10minutestocktrader.com was the company I founded, and I did everything from an iPad, and I would do it under my desk at work, and so that's where the name 10-minute stock trader came from. But I was on a business trip, had my iPad, sat down in the back of the Uber, and I'm like, well, I don't have any trades on. Let's do it. And so I just sold options on anything and everything. Right. A couple days later, I remember getting home, looking at my iPad, and be like, that was a bad mistake. Because like I had no plan whatsoever. I just had money in the bank, and I'm like, well, better buy some stuff right now. Tell me you haven't been there. Put a P in the chat for poor decisions if you have definitely been there.
To trade options successfully, you need to identify an underlying asset that you can track on a regular basis and understand its movements in and out. This underlying asset can be stocks, an index, commodities, or currencies. There are many finer aspects of trading options that you will learn as you continue trading options. And finally, the most important aspect of options trading is risk management. Because of the magnifying effect of potential losses, the best options traders don't risk more than 2% of their capital in one trade.
I actually go up to 7. I know that might sound a little to you, or it might sound a lot to you, but 7 is where my numbers are at. And I'll just show you like last year real quick. I mean, this year I've literally put on 2 trades, 50-50 win rate. I don't really care at the moment where we're at. But last year, running this 7% position size, I was at, on 49 trades, 91.37% gains. 49 trades, 91% gains. I had a winning month every month except for November. So, like, you don't have to trade. I know you might be thinking, oh, I've got to put, giant moves in, or at the same time, it's like 2% capital is so little, right? You need to figure out where that balance is. But I do trade a bit bigger than that because I know my numbers work.
As trades have the potential to go down to zero, large exposures can prove to be fatal for your trading account. Such losses are sharp and quick and happen more often than one can imagine. Remember, it's best to start small while trading options and build a skill set that helps you generate profits on a consistent basis. After a lot of practice, you could have a decent trading system that throws trades on a consistent basis and is more right than wrong. It's only then that you can expect to be a profitable options trader. Thanks for watching.
Awesome. Cool. That was a great video. Let's rank it real quick, and then we're going to actually act like we're putting on trades. So throw it in the chat. What would you rank this video? Where we at? There. Go. Where would you rank this? I would rank it as a 8. Impressive. I think he did a great job. I feel like he explained a lot of stuff, and I feel like, we all learned something from it, right? I saw lots of P's in the chat. Thank you guys. But Italia said he was none lucky. There may not be any monkey hammers or blowhorns of shames today. Nathan understands so many numbers. Manuel says, I have a terrible mental block when it comes to trading options. I have no clue what I'm doing. Someone please help. Bro, you're in the right place, Manny. I gotcha. Ooh, we got some 8s, some 9s, some 7s. No! Damn it, ESAT. I had to bring out the blowhorn of shame because nobody gets a 7. I know you did that for that reason. Nobody gets a 7. So awesome. Thank you all so much for that. Now let's change gears a little bit and let's actually act as if we were going to put on trades. So we're going to go through the golden ticket trading strategy together, and I'll show you exactly what we're doing. But real quick, Mahesh told me because it is Valentine's night, you probably got other plans for Valentine's night. Know what I'm saying? So he's like, listen, we don't want to have this in Valentine's night. It's actually going to end on the sale. I think he said Sunday at midnight. So I'm going to put this on here. So Sunday midnight, the 64% off sale ends, so you can have a wonderful Valentine's night. I don't want to stop you from that. And if you're already on a trial, just shoot us an email, support@outlier.com, and we'll take care of it from there. So the golden ticket trading strategy, only price pays. Many of you have never seen this before, so I'm really stoked to do this. What trading platform do you use? So I will show you in just a moment. Yeah, I do. Mario Party. That's his plans for the night. Perfect. So I want to start with the market, the 10 over the 20, price over the 50. So if I go to the market, if I go to the SPY, we can see here, it looks like we're pushing new all-time highs here. We have the 10 over the 20, price over the 50. You're aware of that. You know the outlier trend template. So that's step 1. Step 2 is market breadth. Now, market breadth is why I'm not trading, right? We've got some other issues going on too, but we'll start with market breadth. Market breadth has been evaporating, right? What I want to see is the other end of the curve where it's going up. So I want to have my market trend aligned with my market breadth. When they're both moving together, trading is effortless. You will not believe how simple trading feels whenever that happens. So the next step after that, so granted, I will not be putting on trades. This is one of the reasons, is evaluating the master key. So the SPY signal actually has a sell signal today. Another reason why I won't be trading, but we're going to act as if it does. So if this had a buy signal, bullish market trend, bullish market breadth, I'll go through. This is what I do in the mornings with my coffee, is just go through each sector, and you can see the sector breadth. We're not going to do that now, but I'll just jump into financials and show you like each breadth. Each sector has its own breadth, and you can see just how gross the financial sector looks right now. Like, ugh, no, thank you. No, thank you. But we'll move on. Imagine that this is good. If I had any trades on, I look to reduce risk before adding new trades, right? I look to take off trades, roll up trades, whatever the case is, before putting anything on. These are my exit criterias, which we'll talk about in a minute as if we were putting on the trade. So we'll come back to that. Next, this is what I put into the screener, right? So we went through the trend, we went through the breadth, we went to reduce risk. Now we're looking at the screener. So the screener, you get to it by just clicking this button here. And it's going to pop this open. And don't be overwhelmed. There's a lot of settings here, but I'll show you mine real quick. So I leave all the sectors and industries wide open. For the signal return, I want to be positive. I don't know why you'd ever want to have negative, but you can if you want. But these are the outlier signals. Do they perform? That's what we want to know. Capital efficiency. So for Tesla, the capital efficiency at the time that I put this together was at 1.34. Let's see what it's changed to right now. You'll want to know what capital efficiency is. I leave it wide open, but you may want to filter down on this, which is why I'm taking the time to do it. So Tesla, capital efficiency of 4.71. Okay, 4.71. So we can update this as we go. The outlier signals versus buy and hold signals. So outlier signals, 562%, 562, and the buy and hold was at 235 in this range, right? In this time frame. The percent of time that we would be invested using the buy and sell signals. There were 32 signals, average holding period of 18 days, time in the market only 51% of the time, which means 49% in cash. So we change that to 51. So that gives you returns per day, right? Returns per day that you're invested. So this would be 1,148 days invested with buy and hold in our data set versus 583 days in the outlier data set for the buy and holds right there. So that's 51% of the time. So basically 75.6 basis points, 0.756% per day returns versus 0.185% daily returns being in the market, which gives you a capital efficiency of greater than 4. My numbers, obviously, I got some rounding issues somewhere, but that's where that capital efficiency number comes from. So I explain all that to say, if you want a high capital efficiency, you can drop it in right here. I like lots of liquidity. That is so important to me. So greater than $1 million, current signal having a buy versus a sell, obviously. Price change. This is something we implemented in November after November was my first losing month, like for the whole year. And that is a 0 to 5% move because I don't want the outlier move to already have started and trying to catch up with it. I'm trying to get in before the outlier move takes off. So that's a new change that I put in just in November. Market cap, I want everything, don't care, just wide open. Price range, greater than $20 because I am a snob, but you could set that to be whatever. Heat map value, basically wide open on the fear and up to G40, which is near the maximum value. So it goes from G0 to G50. So near the maximum value, but not quite there. Give it some room to run before it totally maxes it out. Heat map, we want to see it moving up. That's the heat map we just showed, right? Right here. The heat map right here, the behavioral heat map, you're familiar with that. And then the uptrend indicator, that is the green in the background, or the red in the background, or the white in the background. So you can pick whichever one you want. Now, when I run this, it takes moments. Take absolute moments. No time at all. In fact, we'll do it right now. Apply filter. Runs through all the stocks that outlier covers, and it gives you some results. So these here, BXSL, ENB, NXPI, and Tech. Now, I've already dropped these into TrendSpider here on my bull list. So we can go through these real quick. So I did the screener. So now I have a list of, I don't know, was that 6 or 8 stocks? Now this is just for the SPY and the Q. I trade it a little bit differently because it's the market index versus individual stocks. So you got to look at it slightly differently. But we'll skip over that for now. Run it through the simple chart scanner. We're looking for no order blocks in the way, no earnings in the next 3 days. The 10, 20, 50, as you know, outlier trend templates moving up on the price of the stock. But one thing that's really important to me is above the prior low. So for example, look at this one. If it were opening down here, or if we're looking at the stock and it's already below the prior day's low, that is not what you want to see in a bullish trend. We want momentum behind us. We want things moving up. And if it's below the prior day's low, I'm really not interested at all. So I would skip over that. So I'm going to run this screener here, super simple, but I'm looking at AMSC because it doesn't have any order blocks in its way. It's got a little bit of room to run, which I'm okay with. BXSL, again, closing on top of this order block here, which is super bullish. We got earnings in a few days, which I love to trade up into earnings. you can see all of these will have the trend template pointing up. And in XPI, it's got some room to run down here. I don't love that it's in a downtrend. I really don't love that it's in a downtrend, but it does fit. So I'm interested in it. Next is when I start looking at an options chain. So where do I start from here, right? If I've got 3, where do I begin, right? If I've got limited capital, where do I begin? No problem. Start with the highest back test of the 3 and work your way down. So you take your 3, so AMSC, and you go into your screener, look at AMSC, has a 529% outlier return, which is crazy. Probably not going to get higher than that. Or BXSL has, where's BXSL? Oh, 8% outlier return. Or NXPI has a 25% return. So obviously, the big winner of the guy is AMSC. So next, this is a new thing, right? We now have the ability to filter out on the screener that the heat map isn't already stalled, that the heat map's continuing to move up. You can go moving up, moving down, or no change where the heat map stalls. Like you can do any of those, but of course I want moving up. So I really do need to delete that. So then I go to the options chains and I start at 21 days out. 21 days gives it time to work without having to pay too much. So we're going to go to AMSL. Does AMSL not have options? Well, that was a terrible example. Okay. Or is this just so freaking slow right now and it's like frozen? Let's try it. Hang on, let's try a different stock. Let's go to Tesla. Okay. Maybe AMSL doesn't have options. That could be the case. Oh, that would be because it's AMSC, Chris. That would be because it's AMSC. Wow. What a difference. What a difference. Okay, so looking at this, let's start on the PowerPoint and work our way down here. Starting at 21 days to expiration. So at the top here, we're going to have different expiration cycles. You can see that 7 days out, 35 days out, 62 days out. You can also change this to be weeklies if they have weeklies. I personally only look at the monthly options because those are the most liquid. So if I'm either going to go 7 or 35, clearly I'm going to go 35. Next, 250 plus open interest. Here is a big pro tip. I have never found options volume to be reliable at all. I've never found volume to be reliable. I'll put on trades and it doesn't show up. And I'm like, well, clearly that doesn't work. So I look at open interest. Now, open interest is who wants to actually transact with you, right? Let's say that Nathan, right? Let's say Nathan in the chat is bearish on AMSC, where I'm bullish on AMSC. So Nathan may be like, you know what? I want to sell some calls. Who's looking to buy? So he starts, putting out orders or whatever. And then those are going to collect. And so for me, what I want to do is I want to find a stock with at least 250 open interest. By 250, basically the rule of thumb is you want to go 4 to 6 times as big as you're going to trade, right? So if you're putting out 40 contracts or 60 contracts, that 250 gives you some room, right? 40 to 60 contracts gives you plenty of room. Now, I've also put on hundreds of contracts before, and you want to make sure you're plenty of liquid to be able to do that. So that's why I'm looking for 250 plus, right? 250 or greater. Now, I'll fudge it a little bit, right? If it's like 224, 207, I can live with that, but I'm looking for 250 or more. Next, 50-cent bid-ask spread. What is the bid-ask spread? So this is the price you would pay to buy the option. We're going to focus on calls. The same would apply to puts, but we're going to focus on calls. This is the price to buy the option. This is the price to sell the option. Notice there's a spread between the two. The market makers want their cut, okay? But here is an important thing. If I am going to buy it at $5.40 and then immediately sell it back at $5.10, how much is that? So 0.3 divided by 5.4. So that's 5% of this stock between the bid-ask spread, or 5% of the option on the bid-ask spread. That sucks, but it's just part of what you have to pay to play the game. 50 cents, however, would be, actually, let's look at this one right up here. And this is what I was talking about earlier about the spread widening out, right? See, this right here goes from $8 to $5.70. So 8 minus 5.7 is $2.30. So $2.30 divided by $8 is 28%. So 28% of your option price, pay attention here. If 28% of your option price is evaporated between the time you buy it and the time you sell it, that sucks. You're never going to get ahead. It's not going to work. So that's why I look for 50 cents or less. Of course, it's going to change a lot, right? On a small stock, 50 cents is huge. On a big stock, 50 cents is nothing. But for me, that's what I want to see for liquidity. Next, 20% or less extrinsic value. So we're going to go real deep options theory here for a moment. At the money, or even out of the money, 100% of this is extrinsic value, right? So let's look at the extrinsic column here. 238 is the midpoint between 505 and 270. 220 is the midpoint between 210 and 230. Okay. Extrinsic value goes to zero on every stock, on every option, every expiration, every time, right? So for me, I want to pay as little of that as possible. Again, Larry Hyde taught me this. I want to pay as little of that as possible. So I look to go deep in the money. So let's show you what I mean. So if I go from the 32, which is at the money, where it's all extrinsic, and I go to like the 20, right? We're $20 deep into it. How do we calculate this? I told you I was going to get real deep in math today. Welcome to my world. I love this stuff. So if we are $20 in the money, or $20 strike, I should say. Let me see if I can highlight that. There we go. That helps. If we're at the $20 strike, the current price is $31.69. So 31.69 minus the strike price of 20 is $11.69. Okay. $11.69 is how much moneyness it has. This is how much intrinsic value it has. How much moneyness, moneyness is the word. The other bit, right? The other bit, if we're looking at, so this is $3 wide, maybe not the best example, but still. The other bit of it between 1169 and 1360, 1169 minus 13.60, that's your extrinsic value. That decays to zero. Okay. That's what we want to pay as little of. That's how you calculate intrinsic, which is the difference between the price of the stock and the strike price, and the intrinsic and extrinsic value. So that's how you calculate that. Now I want to pay as little as possible. So if I go on here and I look for these options here, they usually always turn out around the 80 delta. What is delta? Delta is the change in value of the stock for every, or let me rephrase that. Delta is the change in value of the option for every $1 change in the stock. So if you had a 20 delta option and the stock moves by $1, your option will grow in value by 20 cents. If you have an 80 delta, if the stock goes up by $1, your option goes up by 80 cents. That's how they correlate together. So for me, it's usually always around the 80 delta. And check this out. 30 cents wide, 24 open interest. So I wouldn't be interested in that. But if I go down a little bit here to the 28 strike, it's at 73 delta, open interest of 387, 30 cents wide. What's our extrinsic value? So we take 156 divided by the ask price, which is 540, 1.56 divided by 514, 28%. A little juicy for me, a little pricey, but I might be interested in it. I might be. So that is how I would look to set up a trade using golden ticket trading strategy. It is a lot, and I go fast. And when I put on trades, it's not playtime. It's time to make money. Like, this is how it's done. But no trade set up for me today. Not yet, at least. But of course, I want you to come back and I want to help you save time, make money, and start winning with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you watch those. I recommend you have a fantastic day. We'll talk soon.